Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 273. Today's topic is your portfolio beating the benchmark? A lot of folks, and while most of you who are Twitter savvy and are on top of your investments, you probably are well aware of what your portfolio is doing, but a large number of people who invest but do not track what is their investment doing over 6 months, over 1 year, over 3 months, are totally clueless about what is their XIRR, what is their overall portfolio returns. They will keep adding money, keep removing money, never knowing what exactly is the money returning, and do they need to make any course correction in case they want to move from one fund to the other or move from one strategy to the other. So this is very important to at least have some sort of a guiding framework where every 6 months, every 3 months, every month, every 12 months, you are creating some statistic of where your portfolio is going, how is the benchmark doing in the same period, and then over a period of time you will come to see that whether your underlying strategy or your underlying combination of strategies is doing you good, or is it no point doing all that and just putting your money in some index fund instead. So that awareness is very important, and that's what we're going to talk about today. Markets opened with a huge gap down. There has been amazing amount of overseas negative cues. There is inflation concerns, there is hawkish talk of interest rates going up further. Yields are going up everywhere, dollar index is rising, emerging markets are getting crushed. So Nifty opened dramatically down, recovered somewhat. In the morning it was down, I think, more than 2.5% also, but then recovered to about minus 1.4%, stayed there for most of the day. Within the sectoral makeup, obviously IT was hit the most, behind 4% Nasdaq fall. IT sector and Nasdaq trends are very, very correlated. So if IT does well, if Nasdaq does well in the US, IT stocks do well, and otherwise. And all the other sectors where there was some profit taking, some recent run-ups, they also fell badly. Bank Nifty being primarily responsible for the fall there, both private and PSU banks falling, and metal stocks along with real estate stocks, some infrastructure stocks also fall. The only sector which sort of held fort and which was expected in defensive move on such a day was FMCG and some consumption stocks. So overall, I would say that IT stocks continue to bleed, minus 24% for the financial year. But the way the market was set up this morning, from that perspective, I think we did quite reasonably well in avoiding a very major sort of a capitulation or just dramatic drawdown today. As you can see, small cap index managed only to fall only 0.6% along with Nifty Next 50. Mid and small cap index also down only 0.75%. And CNX 500 of course was down more, minus 1.15%, CNX 200 minus 1.2%, and Nifty was minus 1.4%. Within the small cases of weekend investing, MIATH2, MIATH both closed in green. So that tells you, the sort of the relative strength of the stocks in there, at least the ones that are there right now. MI30, MI50, MI25 all down minorly. NNF10 also down only 0.4%. EverGreen was down 0.6%. So most of them beating the fall by a reasonably good margin. And the new entity MI India top 10 also falling only 0.76% versus 1.4% on the Nifty. So each such fall day, if the strategy falls less, and each gain day, if the strategy can do a slightly more than the Nifty, then you've got the alpha, right? Both on the upside and on the downside. So that's what is one would look for. Heat map for the day, a lot of heat. Banks all red, IT deeply red, some green here in FMCG, consumption stocks, energy also down, Autos kind of mixed bag with Maruti up on the battery and EV focus. Tata Motors down 2.5%, although Bharti Airtel also down 1.5%, L&T also down. So reasonably down day from that point of view. But some stocks, KRBL jumping up 7%, Web of Global 8%, Aegis Logistics 10%, Mazagon Dock 11%, and Polymedicure 14%. These were some of the large gainers in the top 500 universe. The big losers, InfoEdge minus 6.29%, Network 18 minus 6%, Tata Elxsi after running up so hard, and I think we also have it in a couple of portfolios, down 5%, Gujarat Ambuja Export also down 5%, and Hinduja Global minus 5%. So this was a tweet that I did this morning, I think, and it shocked me also that 82% of large cap funds don't beat the benchmark or didn't beat the benchmark in the last 5 years on a CAGR basis in terms of returns. And I was just shocked out of my mind. One would not expect, that kind of a large figure. So this is the report that I had reference to, and this is from S&P Dow Jones, Morningstar, and AMFI, and this data is as of December 2021, so slightly dated data, but still for that period of 2017 to 2021, 5 years, where we saw a good amount of up and down in the market, and Nifty probably doing somewhere around 13-14% CAGR in that period, 15-year period. 82%, that's the figure right here, and I'm seeing over a 5-year period, because 1 or 2 years don't give you that much of a picture, and 10 years there's not too many funds that have lasted 10 years. So 5 years is very good amount of time to prove that whether your strategy is working or not. So 82.2% funds did not beat the index, and these are large cap funds in the first category. In the ELSS category, 79% did not beat. In the mid and small cap, 58%. This is slightly getting better, and of course others are bond. And if you do on a risk adjusted basis, then also the figures are 72% did not beat and 76%. So this is, for me, this is unacceptable sort of a statistic to read. That 82% of large cap funds, when compared to S&P BSE 100 large cap stocks, are not performing. So my estimate is maybe like 10 lakh crores maybe riding on this large cap names in this category, and maybe 0.5% of expense ratio may be there. So if 10-15 lakh crores worth of AUM is riding, and 0.5% of 0.6%, 0.7% type of expense ratio is there, then $1 billion of fees has been paid. $1 billion of fees paid every year for not outperforming the benchmark is unfair, I feel. I'm not trying to name anybody. I'm not trying to pull any particular vehicle down, whether it's mutual funds, whether it may be PMS, whether it may be small cases. But if we are, as research house or as fund management, some people are doing, if we are not able to beat the benchmark in 5 years, what are we doing actually? So from that perspective, I think this is a alarming figure. You must know how your fund manager, small case research company, PMS manager, whoever is giving you research or advice, how they're doing. Give them some time in case there is, some few years of good and bad. But overall, if there is a continuous sort of underperformance, then you should leave them, and they should also leave this,
attempt to do this. This is not really done. I mean, if one has to do only benchmark returns, then one can go to an ETF. What is the need of any active management there? So this, and now this is from another CNBC article, and this is for the US market. So it was not just in the Indian market that this scenario is so bad. So performance of active fund managers over a long period, over 10-year period, only 25% active funds beat their passive counterparts. It's a huge statistic even for US market. Recent report from S&P Dow Jones, 12-month period, 58% large cap funds, 76% mid cap, and 78% underperformed. But I would think 12 months is still okay. Let's discount this. 12 months is not a good time to compare, because there can always be 12 months where you underperform. But over 5-year period, 10-year period, you have to perform. It is critical to account for survivorship bias. I was recently talking about survivorship bias at a recent conference. And this is one of the most important thing that we don't pay attention to. Survivorship bias clouds everything. You know, we look at star fund managers, we look at star investors, we look at star stocks that have done well over 10 years, 20 years. But though that is only a 1% selection out of 100 which has done well, and that may have done well due to some luck factor or some timing issue or something. That does not really mean that every time it can be like that. So 40% large cap funds failed in a 10-year period in the US market. They did not even survive. That's because many fund managers are terrible stock pickers and their funds are closed. So much for long-term investing without knowing what you're doing and with whom you're doing this. Very good example, my favorite, Peter Lynch. I really admire Peter Lynch and his wisdom, and he ran the Magellan Fund, delivering an astounding 29% annualized return between 1977 and 1990. 13 years of fantastic returns. One of the best fund managers ever to be produced. But what is the irony? The irony is that the fund made 29% CAGR in those 13 years, but the average fund investor lost money in that tenure also. So first we have to see that whether our fund or fund manager is performing or not. And the second question is whether we are performing as per the fund manager or not. So there are two legs to this equation. First, your fund manager must perform. And second, you must not underperform the fund that you are invested in. How you will do that? By bringing in capital when in a year, where it has gone up 80%. By taking out capital in a year where you were down, let's say 30%. So you are trying to preempt the cycles of the market by bringing in capital, taking out capital, doing lump sum investments at the peaks, withdrawing lump sums at the bottom, trying to time the market. I'll go out of the market for 6 months and come back again in later. So while the vehicle that you chose was the best vehicle for those 13 years, but your own behavior caused you to ruin all that return that vehicle was going to be able to give you. So two levels of risk here. Fund manager level of risk, whether he is one of those 82% who will not perform. That's a huge statistic against you. So only 18% probability that you will beat the index. Within that 18% probability, how are you going to react to various markets ups and downs? If there is a probability of, let's say, only 82% for you also to perform as per the expectation of the investor, then that probability actually reduces to less than 1% or something like that. So please think about these things very deeply. It is not easy that you just invest money somewhere and it will grow on its own. पैसा अपने आप से नहीं बनता है, पैसा आपको कमाना पड़ेगा, आपकी भी मेहनत लगेगी. आप किसी को फॉलो कर लीजिए, किसी को पैसे दे दीजिए. You will need to be involved. Your hand will be required in that process. Your hand, your mind, whatever. So again, just summarizing, 1980 was the year where the Magellan fund got 80% return. A lot of funds came into that year If somebody had invested $10,000 till then, in that year they brought $90,000 more. Next year, fund underperformed, took out money. Overall, CAGR ruined for the individual. A brief plugin for top 10. Many users have asked us to continue the current offer for 3-4 more days till Ganesh Chaturthi, till people get their salaries, so on and so forth. So we've extended the offer to September 1st. The results of this strategy are there in front of you of the last 6 years. We can only hope that the next 6 years will be like this or better, but there cannot be any guarantees. The basic design of the strategy is built in such a way that we remove weakness from the index constituents and stay only in the strongest sector. Many examples that I gave in the past where stocks go out of the index but they fall before they go out of the index. That load that they incur on the index stocks, where you are holding an index fund and you are having to hold that stock, gets eliminated when you are taking only the subset of the index. So if just for illustration, this is how 100 rupees moved in top 10 versus the index. So our belief is that unless we are able to beat the index, there is no point of us providing any service of any kind. So if you wish to enter, you can use EXT40 as a offer code for this top 10. This has been extended now to 1st of September. So thank you so much for watching this episode. I hope you will take away some good learnings from this very important message, that please be aware of what is the performance. Please be aware of what is your role in achieving that performance. It is not just the fund manager, it is you also. Thank you for watching this, and please do share it with as many people as you like, because this is, and minus the momentum investing, minus our product, whatever may be our pitch in this, just the fact that your investing should be monitored, your performance should be known to you. You have a very big role in achieving what the vehicle that you've chosen is giving you as returns. So your behavior is also very, very important. So please share it with all your friends who invest. I am sure they will have some good takeaway from this. Thanks. Bye.